Bitcoin is trading at $63,600 right now, and that number is lying to you. Not because it's wrong, but because it's the least interesting fact about this market today. Because underneath that price sits a set of on-chain readings so extreme that one of them, reserve risk, just printed in the second percentile of its entire recorded history, not the 20th, the second. That single metric is telling you the reward for accumulating Bitcoin right now, relative to the conviction of long-term holders, is close to the strongest it has ever been. And almost nobody is talking about it because it's easier to point at a candlestick. So in this video, I'm not going to waste a single second. Every part of this breakdown is going to hand you a specific number, a specific signal, and what it actually means. The valuation metrics, the holder data, the exact ETF flows, the derivatives, the mining side, and the one catalyst that could turn all of this coiled potential into an actual move. Let's go. Start with price context, precisely. Bitcoin is at $63,600, up 5.6% over the past 7 days from a low near $60,288. Over that same window, it flushed towards $62,000 in a liquidation event, bounced hard, tagged $65,000, got rejected, and faded back to here. In the last 24 hours, liquidations across the crypto market ran between roughly $75 million and $350 million, depending on the window, with over 80,000 traders wiped out on the heavier days. That's the surface. Now let's go under it, metric by metric, because this is where the real information lives. Metric 1, MVRV, market value to realized value. It's sitting at 1.21 in the 18th percentile of its history, with a z-score of 0.35. In plain terms, that means the average Bitcoin in existence is only about 21% in profit. Compare that to cycle tops, where MVRV blows out to 3, 4, or higher, and coins are sitting in massive unrealized gains. At 1.21, this market is unambiguously cheap by its own historical standard, nowhere near the overheated readings that mark tops. That's your first hard data point, and it frames everything else. Metric 2, NUPL, net unrealized profit and loss, reading 0.173 in the 18th percentile. That keeps the market firmly in what's called the fear band, the zone where the aggregate holder is holding only modest unrealized profit. At real cycle bottoms, NUPL dips near or below zero. So we're cheap in the fear band, but not yet at the deepest capitulation extreme. That nuance matters, and I'll come back to it. Metric 3, and this is the standout. Reserve risk at 0.00051, the second percentile. Reserve risk measures the reward for buying relative to the conviction of long-term holders. When it's this low, it means long-term holders are refusing to sell despite the price. Their conviction is high, while the price is low, which historically has been one of the most asymmetric accumulation setups Bitcoin ever offers. The second percentile means this reading has only been this favorable about 2% of the time in Bitcoin's entire existence. That's the headline signal of this entire video. Metric 4, SOPR, spent output profit ratio, aggregate reading 1.0008, 35th percentile. That number sitting almost exactly at 1 means coins are changing hands at roughly break even. Translation: the selling happening right now is exhausted low-intensity selling. There is no euphoric profit-taking, no panic-driven loss realization at scale, just tired break-even transactions. Exhausted selling is exactly what you see late in a correction, not early. Metric 5, VDD multiple, value days destroyed at 0.409, 17th percentile, sitting in its green zone. Green means cheap. Metric 6, RHODL ratio at 915, 25th percentile E, low, again confirming we're nowhere near a top. Metric 7, coin days destroyed on a 90-day average at 8.23 million, 39th percentile, meaning old coins are moving less than average. Long-term holders are sitting still, not distributing. Every single one of these 7 valuation and momentum metrics is aligned to the same conclusion: cheap, fearful, exhausted selling, high holder conviction. When this many independent oscillators agree, that's when the signal has weight. Now the holder structure and these numbers are the backbone of the bullish case. Long-term holders, defined as coins held more than roughly 155 days, now control 16,526,953 Bitcoin. That's 83% of the entire circulating supply, 83%. And over the past 30 days, that cohort grew its position by a net 302,972 Bitcoin, while short-term holders shed 265,825. Read that again. Coins are maturing out of weak hands and into strong hands at a rate of roughly 300,000 BTC a month. That is the mechanical definition of the transfer from weak hands to strong hands, quantified exactly. But here's the crucial nuance that separates real analysis from hype: the holder cost basis. The long-term holder realized price, their average cost basis, is $49,272. The short-term holder realized price is $69,142. At today's price of $63,600, that means long-term holders are sitting deeply in profit, about 30% up on their average cost, and therefore completely unmotivated to sell. Meanwhile, the average short-term holder, the recent buyer, is roughly 8% underwater. This is a textbook late correction configuration. The strong hands are relaxed and profitable, the weak hands are underwater and shaken. And it has a direct trading implication I'll get to, that 69,000 short-term cost basis is a magnet for break-even selling on any rally. Now let me give you the cohort accumulation data, and I'm going to be honest here in a way most channels won't. Over the past 30 days, essentially every wallet band added supply. The genuine whale cohort, wallets holding 1,000 to 10,000 Bitcoin, grew by 13,664 BTC, up 0.32% to 4,250,046 Bitcoin. Retail wallets under 1 Bitcoin grew by 12,877 BTC, up 0.92%. And the largest cohort, over 10,000 Bitcoin, which is mostly ETFs, exchanges, and custodians, not individual whales, grew by 28,075 BTC. Here's the honest read. This is broad, low-intensity accumulation across every cohort. It's constructive, but it's not the dramatic whales buying while retail dumps divergence that makes for a clean, emphatic signal. Everyone is nibbling. That's quietly bullish, not explosively bullish. And you deserve the accurate version. Now the part that explains why, despite all this cheapness, Bitcoin isn't ripping. The demand engine has stalled. Since 2024, spot Bitcoin ETFs became the dominant marginal buyer, the force that sets the price at the margin. And over the trailing 7 days, that channel was a net seller to the tune of negative 36,983 Bitcoin. Let me scale that for you so it lands. Post-halving, Bitcoin issues about 450 new coins per day, roughly 3,150 per week. So an ETF outflow of nearly 37,000 BTC in 1 week means the ETF channel absorbed negatively about 12 weeks worth of new supply in a single week. That is a massive demand-side headwind, and it is the single biggest reason cheap valuation hasn't converted into an uptrend. And here's the inflection to watch. The flows are trying to turn. Earlier in July, a 10-day $2.73 billion outflow streak ended with a 3-day stretch pulling in $510 million led by BlackRock's IBIT. On individual days, IBIT has driven inflows of $209 million on July 6th, contributing to a $266 million total that day. More recent daily prints have been positive but modest. Figures like $79 million or a $136 million IBIT-led week. So the picture is a channel that bled nearly 37,000 BTC over a week, then started flickering positive in tens and low hundreds of millions per day, stopped hemorrhaging, turned tentatively positive, but nowhere near the billion-dollar conviction days of true institutional euphoria. And for the full year 2026, spot Bitcoin ETFs are still net negative by something on the order of $5 billion. That's the honest scorecard. Now the exchange flow data, because it tempers the bull case and you need to know it. The latest daily net exchange flow is a modest positive 580 Bitcoin, an inflow-outflow ratio of 1.019. And over the past 30 days, exchange reserves have actually risen by 12,766 Bitcoin, up 0.47%, to 2,752,223 BTC. This matters because the classic bullish signal at a bottom is coins draining off exchanges into cold storage. Reserves creeping up instead of down is the wrong direction for a clean accumulation thesis. Now zoom out and exchange reserves are still near a 7-year low, around 2.2 million on some measures, so the long-term supply squeeze is real. But in the last 30 days specifically, the exchange channel is awash. No aggressive distribution, but no confirming supply squeeze either. That's the balanced truth. Now the derivatives data. The Bitcoin perpetual futures funding rate is sitting around positive 0.007%. Barely positive, essentially neutral. That tells you leverage is not stretched in either direction. Longs aren't paying an extreme premium, and shorts aren't dominating. Combined with the recent liquidation flush that wiped out the over-leveraged longs, the derivatives market has been reset to a clean, low-froth state. That's constructive because it means any move from here is less likely to be immediately choked off by a leverage unwind. Now the mining and network fundamentals, which almost no price-focused channel bothers to cover. Bitcoin's mining difficulty currently sits at 127.17 trillion. It fell about 5% on July 11th, and hash rate and difficulty are down roughly 8 to 9% from their 2026 highs, with one earlier adjustment dropping a full 10% the second largest drop of the year, as the June price slide pushed less efficient miners offline. Here's why that matters. Falling difficulty after a price drop is the network self-correcting. Weak miners capitulate, difficulty drops, and the remaining miners become more profitable per unit of hash. Historically, minor capitulation and difficulty resets have often clustered near price bottoms, not tops. Yet hash rate hitting all-time highs earlier in 2026 also signals persistent long-term conviction in mining despite weak price, a fundamental disconnect where the network keeps getting stronger while price lags. Now the sentiment data quantified. The Crypto Fear and Greed Index reads 23, deep in extreme fear on some measures, having recovered from around 20 at the flush toward the high 40s on others depending on the index used. Extreme fear at cheap valuations is historically one of the most reliable contrarian buy conditions in Bitcoin's history. The crowd is most terrified precisely when the asset is most discounted. But note the discipline here. Fear zone valuations can persist for months. Cheap can stay cheap or get cheaper without a catalyst. And that brings us to the macro backdrop, which the data describes as benign but passive. The macro risk index reads 21.1 DOX, low risk. The VIX, the equity market's fear gauge, sits at 16.6, signaling calm stock markets. The 2-year 10-year Treasury spread has re-steepened to positive 0.31 out of its earlier inversion. The 10-year yield is elevated but stable at 4.48%. The dollar index sits at 100.87 JOS, neutral to firm. Here's the interpretation. Macro is permissive, not fighting the accumulation case, but it's not actively financing it either. The missing ingredient is a decisive easing impulse or a weaker dollar to pull liquidity back into risk assets. A falling dollar has historically amplified on-chain accumulation. A firm dollar just lets it sit there, coiled. So now let's talk about the catalyst that could actually flip this, the Clarity Act, with the specific facts. The Digital Asset Market Clarity Act, formerly HR 3633, passed the House on July 17, 2025 by a vote of 294 to 134, with all 216 Republicans voting yes. It was reported to the Senate, and on May 14, 2026, the Senate Banking Committee advanced it by a 15-9 vote, with 2 Democrats, Ruben Gallego and Angela Alsobrooks, crossing over. The bill's core function is to divide regulatory jurisdiction between the SEC and the CFTC, giving the CFTC exclusive authority over digital commodities and clarifying when an asset is a security versus a commodity. Senate negotiators have now merged the Banking and Agriculture Committee versions into a unified text, reportedly over 70 pages added, expected to hit the Senate floor as soon as the week of July 20th, which is this coming week. Here are the vote mechanics that decide everything. The bill needs 60 votes in the Senate. Right now, it does not have a single confirmed Democratic yes on the current draft, meaning Republicans need at least 7 Democrats to cross over before the August recess, which begins around August 8th. The blocker is not the crypto mechanics, it's an ethics provision. A block of Democrats is demanding restrictions preventing senior officials, including the president, from maintaining crypto business ties, citing the president's disclosed crypto-related income exceeding $1.4 billion for 2025. Compromise ideas floated include letting state attorneys general sue for ethics violations. Prediction market odds on the bill becoming law in 2026 crashed to a record low 24%, then rebounded to about 45% as the merged text came together, still under a coin flip. That's the precise state of play. Why does this connect to every metric I just gave you? Because the analysis is explicit. This is a cheap, coiled, deep value market missing exactly one thing: a demand catalyst. The ETF channel is the dominant marginal buyer, and it stalled. Regulatory clarity is the single most plausible trigger to restart aggressive institutional inflows. So the on-chain setup is loaded, reserve risk in the second percentile, 83% of supply in strong hands, exhausted selling, and the Clarity Act vote next week is the finger near the trigger. That's the whole thesis in one sentence. Now the technical levels, tied to the on-chain data so they actually mean something. The 200-week moving average, historically Bitcoin's ultimate bull market floor, sits in the low 62,000 region too, and it was tested at the flush and held. Immediate support is 62 to 63,000, overlapping that moving average and the recent bounce zone. Below that, 60,000 is the psychological support and roughly the 7-day low. The deeper demand zone sits at 58 to 58,500, and critically, the long-term holder cost basis at 49,272 is the ultimate value floor, a sustained break below that would be the genuine bear signal, and we are 23% above it. On resistance, the immediate hurdle is 64,000, then the critical 65 to 65,500 zone that rejected this week's rally. But here's the data-driven insight. The short-term holder cost basis is 69,142. That means the entire zone from current price up towards 69,000 is packed with recent buyers who are underwater and likely to sell at break-even to escape. That overhead supply is a real quantified headwind on any rally. It's why 65,000 rejected, and why reclaiming and holding above 69,000 would be so significant. Above that, the 70 to 72,500 region holds the major moving average cluster. The RSI has reset from oversold at the flush back to neutral, leaving room to run without being stretched. And funding at neutral plus, the recent liquidation reset means there's no immediate leverage overhang to choke a move. So the technical picture matches the on-chain picture exactly: coiled, cheap, reset, and waiting. Now let me synthesize into 3 data-driven scenarios. Scenario 1, the bullish breakout. The Clarity Act gains momentum, an ethics compromise emerges, Democrats signal support, prediction odds cross 50%, and ETF flows flip from tens of millions to hundreds of millions or billions per week, outpacing the 3,150 BTC weekly issuance. That restarts the demand engine against a supply where 83% is locked in strong hands. Bitcoin reclaims 64, breaks 65, grinds through the 69,000 short-term cost basis, and the second percentile reserve risk setup pays off exactly as history suggests. Watch for ETF weekly flows turning decisively positive and closes above 65, then 69,000. Scenario 2, the consolidation and wait, honestly the most probable near-term path given the data. The Clarity Act drags ETF flows stay tentative in the tens of millions. Exchange reserves keep drifting sideways, and Bitcoin chops between 62 and 65,000. Cheap valuation persists without a catalyst, exactly what the cheap but uncatalyzed data describes. Reserve risk stays extreme, long-term holders keep absorbing 300,000 BTC a month, and the base builds. Patience wins, the setup matures. Scenario 3, the disappointment and retest. The Clarity Act dies or slips past recess. ETF outflows resume like the negative 37,000 BTC week. And disappointment pushes Bitcoin to retest 62,000 in the 200-week moving average, possibly the 58,000 demand zone. Even then, as long as we hold above the 49,000 long-term holder cost basis, the structural bull thesis survives. It would just be cheaper accumulation. The thesis only truly breaks on a sustained weekly close below the mid-50,000s, well under that LTH basis. Here's your data checklist for the week. 1. ETF net weekly flow, the single most important variable. Watch whether it beats the 3,150 BTC weekly issuance. 2. The Clarity Act floor vote and whether 7 Democrats appear. 3. Exchange reserves. Are they finally draining below 2.75 million or still creeping up? 4. The 69,000 short-term cost basis as overhead resistance. 5. Reserve risk and MVRV staying in the bottom quintile, confirming the value zone. 6. Funding rates staying neutral, not spiking into froth. 7. The dollar index, a break below 100 would be the liquidity tailwind this setup is missing. Here's the bottom line. Bitcoin at 63,600 is one of the most quantifiably coiled setups of this cycle. Reserve risk in the second percentile, MVRV at the 18th, 83% of supply in strong hands growing 300,000 coins a month. Exhausted, break-even selling, a leverage reset, and a network whose difficulty just self-corrected. Every structural metric says accumulation zone. The one thing missing is a demand catalyst, and the ETF engine that stalled at negative 37,000 BTC in a week could be restarted by 7 Senate votes on the Clarity Act as soon as this week. The conviction read from the data is honest. Medium on the setup, low on the timing. This is a patient, multi-quarter accumulation configuration, not a guaranteed next week rocket. And knowing that difference, knowing exactly which metrics to watch and what would confirm or break the thesis, is the entire edge. If this data-packed breakdown gave you information you literally cannot find anywhere else, smash that like button, because it tells the algorithm to push this to more people who want real numbers instead of vibes. Subscribe and hit the bell because I'll be tracking every one of these metrics. The ETF flows, the Clarity vote, the reserve risk, as they update this week, and being a day late could mean missing the exact inflection. Comment below. Do you think the demand engine restarts this month, yes or no? And which scenario are you positioned for? I read everyone. And remember, nothing in this video is financial advice. I'm not your financial advisor. This is data analysis and education based on the numbers available right now, and this market, especially with a binary Senate vote in play, can do anything. Never invest more than you can afford to lose. Never use leverage you don't understand. This week's liquidations, over 80,000 traders wiped out, are the reminder of why. Do your own research, manage your risk, think in quarters, not days. The people who win in Bitcoin are the ones still standing after the volatility clears everyone else out. Stay sharp, stay data-driven, and I'll see you in the next one.